Two distinct forces are colliding in the Indian market. Price charts are breaking down, while external trade data reaches multi-year highs. The technical reality is clear. The Nifty 50 dropped 14%, falling below its moving averages to find support near 22,200. However, US and EU trade deals just cut export tariffs from 50% to 18%, creating a primary growth driver. This creates a stalemate. Foreign investors sold over 8,000 crore rupees on April 6th, while domestic institutions bought nearly the exact same amount. You have to choose between reacting to the immediate price correction or positioning for the long-term trade catalysts. Staying in cash protects you from a potential breakdown, but you lose the current discount. Buying now secures the discount, but exposes you to immediate price swings while the market settles. Deciding which path to take requires applying one of three lenses based on your specific constraints. Lens 1 is the capital preserver. This is for investors with a timeline under 3 months who prioritize avoiding further downside. Lens 2 is the thematic investor. This profile looks at a 6 to 12-month window, focusing on broad sector recoveries rather than individual stock picking. Lens 3 is the active optimizer. This investor operates on a 2 to 3 year horizon and uses mathematical filters to find highly efficient individual companies. Relying on generic market commentary right now can lead to holding the right asset during the wrong time frame. Every sector must be filtered through your specific window of patience. Pharma and IT are currently the high conviction targets for the active optimizer, as both sectors benefit directly from the new US and EU tariff exemptions. Pharma is a primary beneficiary. The EU Free Trade Agreement unlocks $1.2 billion in new exports, projecting a $45.7 billion market by 2035. But specific risks remain. A US FDA import alert can halt growth instantly, requiring an immediate review of the position. In the IT sector, improved US relations reduce the risk of service sector scrutiny. Future performance here will be determined by quarterly deal wins and employee utilization rates. The Nifty IT index dropped nearly 10% in 2025. Because of that, this is a slow recovery toward previous highs, rather than a sudden breakout. Investing in these sectors requires accepting several months of price volatility in exchange for capturing the long-term export growth built into the trade deals. For domestic-focused strategies, the FMCG sector is emerging after 2 years of price stagnation. This recovery is supported by specific consumption data. Rural demand is currently growing at 8.4% per year, while urban growth is lagging at 4.6%. Thematic investors can use this data to target established zero-debt companies that are currently trading at a relative discount because the sector has been out of favor. This strategy is strictly based on mean reversion. It requires a 6 to 12-month holding period, allowing volume growth to translate into earnings. FMCG lacks the rapid growth of tech, but provides a defensive buffer for investors seeking to avoid the broader index volatility. Other sectors are currently exhibiting signs of overheating. Capital goods and defense companies have strong order books and zero debt, making them appear attractive. However, after a 31% rally in 2025, many are trading at PE ratios over 50. Buying at these prices creates a significant risk if valuations return to historical averages. Meanwhile, metals, realty, and energy continue to pull the index lower. These sectors face direct challenges. Metals are dealing with a supply glut from China, while realty is struggling with cooling demand and high interest rates. In energy, the shift away from Russian oil is causing near-term operational friction. Purchasing these broken sectors or overpaying for popular companies are two of the fastest ways to lose capital during a market correction. You can map your investment horizon to a specific action plan using this matrix. The repo rate has been cut to 5.25%, and credit growth is holding at 15%. Because these factors provide a stable floor for earnings, the capital preserver should focus on private banks or cash, until the Nifty reclaims the 24,667 level. The thematic investor should accumulate FMCG stocks. This captures the rural recovery while ignoring the daily fluctuations of the broader market. The active optimizer should use price dips to build positions in IT and pharma, provided they pass strict mathematical efficiency tests. Your results will depend on matching your capital deployment to your actual patience level, rather than attempting to time the exact market bottom. To find the most efficient companies, we filter 5,000 stocks through a 7-tier master screener. The first filter is capital efficiency. We require both return on capital employed and return on equity to be above 15% to ensure the business is generating high value on its investments. The second filter is risk management. We eliminate any company with a debt-to-equity ratio above 0.5 or any pledged promoter shares. This reduces the field to roughly 15 to 35 candidates. These represent research candidates. Each requires individual verification of its management and growth prospects. Even with strong fundamentals, the continued selling by foreign institutions remains a primary threat to near-term returns across all sectors. Navigating this paradox requires looking past the daily volatility. If you align your strategy with your timeline, you gain strategic clarity while the rest of the market reacts to the noise.